BigBear.ai stock is trading live right now at $4.83 per share, experiencing a modest downward tilt of about 2.59% inside the current intraday session, as the broader technology sector faces structural digestion. If you watch the ticker close enough, you notice a dramatic gap between what retail traders are chasing on social forums and what the hard institutional tape is signaling. Most people looking at this company right now think they are buying into a high-octane software scaling asset that is riding the absolute coattails of the massive defense technology expansion. But here's the piece of information that almost nobody is pricing into their current thesis. While BigBear.ai recently booked a massive $53 million sole source classified award that expanded its total backlog by 14% to a solid $281.9 million, its actual top-line recognized quarterly revenue dropped by 1% year over year, landing at just $34.4 million. This means the enterprise is actively collecting giant promises of future paychecks, while its immediate operational machine is essentially running completely flat, burning cash on heavy overhead, and struggling to turn speculative pipeline interest into recognizable high-margin software sales. The conventional wisdom surrounding this name says that because it sits at the intersection of defense procurement and advanced national security intelligence, it is an automatic compounder poised to explode alongside massive defense budgets. After all, the expectation is that national security spending is an absolute defensive moat that protects small boutique software contractors from the harsh realities of normal enterprise spending slowdowns. Retail sentiment on tracking platforms recently flipped to extremely bullish after a wild 20% weekly surge that was capped off by a heavy volume push over the $5.30 mark. The general crowd looks at this price action, sees the partnership announcements with global logistics hubs like PTG in Panama, and assumes the Garushal pivot is already fully operational and running at full speed. They believe the company is effortlessly transitioning from a specialized low-margin government consulting firm into a scalable, high-margin software platform that will eventually command the premium multiples we see across the wider software ecosystem. The reality of the situation is far more nuanced, demanding a highly critical look at the underlying mechanics of their balance sheet and execution pipeline. When you look deeper into the recent stock movement, the reason we are seeing the share price ease from its weekly peak of $5.34 down to the current $4.83 range is that the market is violently colliding with a wall of technical resistance and real fundamental friction. The high volume of trading we witnessed over the last few sessions was heavily driven by momentum algorithms and retail options activity, rather than massive institutional accumulation. Large asset managers looking through platforms like Interactive Brokers or analyzing institutional order flow on the specialized Interactive Brokers platform see a persistent structural problem. BigBear.ai is spending significantly more to execute its current business than it is bringing in through high-margin recurring licenses. Their selling, general, and administrative expenses ballooned to $29.22 million in the most recent quarter, which completely wiped out the gross profit and contributed to a steep operating loss. When a company is losing nearly as much on administrative overhead as it generates an entire quarterly revenue, institutional investors start to treat every single headline-driven rally as a prime opportunity to trim exposure or establish short positions. This deep gap between retail hype and institutional caution is why understanding your trading venue matters so much in the modern market. Investors using general retail setups like the Robinhood app or checking their balances on SoFi Invest often get swept up in the immediate high-sentiment momentum cycles that dominate the daily trading volume charts. These platforms make it incredibly easy to execute quick trades, buy fractional shares, and track what is trending on social feeds, which is exactly why this stock sees such massive intraday volatility swings. On the other hand, seasoned allocators managing significant capital through institutional portals like the Interactive Brokers trading platform tend to focus entirely on the hard corporate filings, the dilution metrics, and the actual cash conversion cycle. They look at the fact that despite a decent revenue beat against consensus estimates, the net earnings per share missed expectations, printing a loss of 12 cents. This stark contrast between retail enthusiasm on one side and cold fundamental math on the other is what creates the massive, violent price swings we're seeing play out on the charts this week. To really understand why the stock is behaving this way, it helps to step back and look at how the entire decision intelligence and data analytics sector is performing across different types of investment accounts. For individuals engaged in self-investing across specialized investing sites, the choice of where and how to hold assets like this completely dictates their risk management. Investors using premium wealth platforms like Schwab Intelligent Portfolios or building out a diversified basket via Fidelity Investments often balance these highly volatile speculative small-cap tech plays with stable broad market Fidelity ETFs or conservative Fidelity mutual funds. The automated allocation inside an intelligent portfolio model will typically limit exposure to a highly volatile stock with a high beta like BigBear.ai, keeping it as a tiny satellite position rather than a core holding. This is because institutional risk models look at the underlying structural health of the business rather than the emotional weight of a single contract announcement. When you manage a portfolio through a comprehensive individual brokerage account, whether it is a traditional Fidelity Brokers setup or a high-tech online investing platform, you are constantly forced to weigh whether the capital you have tied up in a speculative asset would perform better if it were parked in a highly liquid cash management vehicle or a steady index fund.
Comment below how many shares of BigBear.ai you currently hold in your portfolio right now, and let me know if you are actively buying this dip or looking to exit on the next technical bounce. If we look closely at the operational core of BigBear.ai, the actual business model is fundamentally built around delivering complex data conflation, discrete event simulation, and advanced digital identity verification software to high-consequence environments. Founded originally back in 1988 and later transitioning through a major blank check corporate merger in 2021, the company has spent decades cultivating deeply entrenched relationships with the United States Department of Defense, the intelligence community, and various homeland security agencies. Their software platforms are explicitly designed to take massive, completely unstructured and fragmented data sets from global supply chains or national security networks and clean that information so that commanders and logistics operators can make real-time decisions. A prime example of this model in action is their recent rollout of the International Shipping Compliance application with Panama's largest logistics operator, which uses advanced biometric screening and algorithmic tracking to spot smuggling and chain of custody risks across global trade routes. This is highly sophisticated, mission-critical work that general-purpose foundation models cannot easily replicate, giving the enterprise a legitimate technical foothold in a highly restricted, high-security niche market. However, historical performance demonstrates that translating this deep specialized expertise into a highly profitable, scalable enterprise is an incredibly steep uphill battle. Past financial reports show a consistent pattern where massive gross contract backlogs take an exceptionally long time to convert into actual liquid cash flow due to the slow, bureaucratic nature of government procurement cycles. Furthermore, because a significant portion of their historical revenue has been derived from professional services and highly customized engineering consulting, rather than pure off-the-shelf software licensing, the cost of revenue remains stubbornly high. This dynamic keeps their gross margins compressed compared to traditional enterprise software businesses, requiring a constant influx of specialized talent and high research and development spend just to maintain their existing contract commitments. The acquisition of companies like PainJam was a deliberate strategic attempt to aggressively inject more commercial digital identity and biometric technology into the mix to diversify away from pure Defense Department dependence. But integrating these distinct corporate architectures takes time and capital, leading to the flat near-term organic growth rates we're seeing in the latest financial statements. Looking out into the near future, the ultimate trajectory for this stock will be entirely defined by whether reality can finally catch up to the massive expectations built into its valuation. There are two very distinct scenarios that could play out from here over the next several quarters. In the bullish scenario, the massive $281.9 million backlog begins to rapidly convert into recognized revenue at a much faster clip than the market currently anticipates, driven by accelerated procurement timelines from federal agencies facing heightened global geopolitical pressures. If the Panama logistics deployment proves to be a highly successful case study, it could serve as a powerful validation tool that triggers a massive wave of commercial adoptions across other major international shipping hubs and customs agencies throughout Latin America and Europe. This would successfully shift their revenue mix toward repeatable, high-margin software as a service lines, allowing the business to finally leverage its heavy fixed administrative overhead and march toward consistent operational profitability. In this environment, the stock would likely break through its heavy technical resistance levels, sparking short covering and attracting sustainable institutional capital through major brokerage platforms. Conversely, the bearish scenario presents a highly material risk that investors simply cannot afford to ignore if they want to protect their capital. If the conversion of that massive classified backlog continues to stall due to administrative delays or changing federal budget allocations, the company's top-line revenue will remain completely stagnant. This would force them to continue operating at a heavy net loss, rapidly draining their existing cash reserves to fund their high operating expenses and costly research and development initiatives. Under these conditions, management would likely be forced to turn to the capital markets to raise additional liquidity, resulting in significant shareholder dilution through equity issuance or expensive debt facilities that would place a hard structural ceiling on the stock price. Furthermore, if the broader commercial adoption of their logistics and biometric applications fails to gain material traction outside of the early pilot programs, the market will completely lose faith in the commercial expansion narrative, revaluing the entire business strictly as a low-growth government services contractor. To wrap things up, the central struggle defining this asset is the massive tension between a highly compelling macro narrative and a deeply constrained fundamental reality. The market expects a high-flying, hyper-scalable defense technology play that can effortlessly compound value as global security and logistics risks escalate. The reality on the ground shows a business that possesses genuine technical specialization and an expanding book of future business, but one that is currently weighed down by flat near-term revenue growth, heavy operating losses, and significant execution friction. For retail momentum traders using fast-executing apps, the stock will continue to provide incredibly lucrative short-term trading opportunities driven by raw sentiment waves and breaking headline contracts. But for long-term investors looking to commit substantial capital, the company still needs to prove that it can convert its massive piles of contracted backlog into highly profitable recurring cash flow. Until that fundamental transition clearly shows up on the official income statement, the stock will remain a highly speculative, high-beta battleground asset where expectations and reality remain locked in a very sharp, volatile conflict. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.